So today on the podcast, we have Jorge Abreu, and I met George in Vegas and when we went to the Multifamily Wealth Project and learned a little bit about him. And I learned that you started in the residential side of things. So like fixing and flipping with your construction business and different things you were doing, but then eventually transitioned over into the commercial side. And one of the things that you mentioned to me was your first multifamily deal. I don't remember the exact size, but I think it was like 30 or 40 units.
Pretty
And
close, 37, yeah.
37. And then eventually you moved on to like 200 or something more. It was like your second deal, right? And then I think if I heard another podcast correctly, you went and like did like 1,000 unit portfolio like after that or something like that.
That's about right. Yeah, I think there was one in between that was about 200 units, and then we did a portfolio of 1,275 units.
So those are really big jumps from. So I was like, how did he like go from one then to the other, then something so massive so quickly, right? And I wanted to ask you about that. Was kind of one of the things that you had to learn when transitioning into such larger assets that maybe you didn't know when you were first starting out. And so I wanted to kind of go through that a little bit, if you could kind of run through that process and what you've learned.
Absolutely. So, the first one, it was 36 units when we bought it. We turned the office into another unit, so it ended up being 37. Learned a lot on that deal. One thing I learned was I didn't want to do anything under 100 units after that because I couldn't have the proper staff on site, and that makes things a little more difficult. I also learned it was sort of the proof of concept, right? I was with the education I had and the knowledge and the experience, I was pretty sure I could do it, right? But that one deal let me know that, hey, I can definitely do this. I can execute. So that kind of gave the confidence to keep going. Like you mentioned, the next one was over 200 units. It was about 216 unit. The on-site management part of it was much easier because now we're managing the on-site staff versus having to really get in the weeds of it. Started kind of building up our track record and being able to raise equity. That was the first deal that we actually raised equity on, so we felt comfortable with that. So then we did another 200 units so property, and then at that point something larger came by our desk, and it didn't seem much different other than we're gonna have to raise a lot more equity, right?
Right.
The management part of it was 5 properties where roughly they were, in the 200, 300 unit range. So we felt comfortable with that at that point. So it was just really putting the team together and being able to take down that size of loan and also raise that much equity. So I believe it was about a $70 million deal, $50 million loan with about 20 million in equity, if I remember correctly. So, we went all in. We were able to do it. And like I say, it was easy raising that much equity, but definitely learned a lot on that deal as well. And yeah, I mean, really just the numbers get bigger. The rest of it is pretty similar as far as the acquisition process and executing the business plan. Everything else is pretty cookie cutter.
What are some of the misconceptions you had about raising the equity part of things? I know your second deal, you really started raising, and then once you got to that big portfolio, you really had to raise a lot more. So maybe what are some of the misconceptions you had before you had to go and raise the 20 million from, before you actually did it?
Yeah. few things there. And this is with raising equity for any deal. You know, I think we underestimated the amount of follow-up you got to do on some of these investors, even the ones that seem like they're ready to move forward, and just actually getting them to sign the paperwork and send the funds. So having a good system in place, having a good CRM, that's something that, you know, now it's a must for us, especially at the scale that we're at. And it's something that we kind of underestimated in the beginning. And then a mistake we made there, and a mistake that I see all the time, was counting on a big check writer. So, you know, we had somebody signed up for about half the equity. They were going to come in with 10 million. And then as we started moving forward, eventually they dropped off. You know, they just decided not to do the deal. And it was pretty close to closing. So, you know, at that point we had secured the other 10 million, but now we were short 10 million.
Right.
So
take me back to that moment when you realized you no longer had half of the equity. What goes through your mind, right? And what did you think to problem solve, I guess, at that point? Because you said it was close to closing.
Yeah. You know, at that point we had maybe $1 million into the deal, I think. So, you know, the first time we got word that they were backing out, I mean, my heart skipped a beat for sure.
Mm-hmm.
But I've always kind of been somebody that, you know, when my back is against the wall, or there's a certain situation, I don't waste a lot of time. Like, I know, hey, we got to take action, right? You know, what do we got to do? So we went back to everybody that we had reached out before, and you know, pitched the deal again, and found somebody from that list eventually that could pull it off and get it done in time. But didn't waste much time. You know, maybe that maybe lasted 10 minutes of freaking out, and then straight into taking action.
Awesome. And I mean, I don't know how long ago that was. I think it was a few years ago, but compared to now, in today's market where, you know, you have to raise a lot more equity in order to get some of these deals done, right? Where before maybe you only had to do 20, 30% of the total loan to value. Now, I know it's growing to like 40%, I guess, for some deals. So you got to find a lot more equity to actually take some of these down. So what have you seen that has maybe shifted from investors, you know, before to now? Or what are maybe some concerns or things that they're asking you now that maybe they didn't before?
Yeah, I mean, there's definitely concerns on the market and everything that's going on, right? Some investors that are choosing to sit on the sideline. We just focus a lot on kind of educating them. You know, if you sit on the sideline and you don't do anything with your money, and you still got some inflation, I mean, you're literally losing money. You know, there are some more conservative, possibly, places you can put your money and get, you know, maybe 4 to 5%, but that's all you're going to get. You know, is 4 to 5% really going to move the needle for you and get you where you want to be? So a lot of just educating the investors. Some are going to take that education and move forward, and some just are not, right? Definitely more investors, more questions, right? Which good questions, which we like those, right? But overall, you know, we still, our investor base is still pretty active. You know, they know they've got to make their money work for them. Yeah, you know, we're the deals that we invest in and the deals we acquire, they are in good locations that got good metrics, right? And it's kind of easy to present that to our investors and show them why we're excited about the certain deal.
Right. I think you guys have a deal that you guys are presenting right now, right?
Correct.
And so, one of the things you mentioned was you maybe were acquiring from like developers that maybe like asset management really isn't their isn't their niche, right, or their expertise. And so, tell us a little bit about that. Making these relationships with developers, like how are you dealing with the financing? Are you getting these like right after they build them, or maybe a few years down? And just talk to me a little bit about that. Like, what have you learned through that process?
So all of the above, as far as what phase. We've passed a couple years. We've done several of these now. We started with one right when the developer was somewhat stabilized with occupancy. Um, there was still, they hadn't pushed the rents, right? They just wanted to get it to the point where they could sell it and move their money to another development project. So I think that's when we kind of noticed this niche, and um, very successful with that deal. So then we've got a couple where we've acquired it upon just CO. So literally they're finished with the property. They have their certificate of occupancy, and we come in and take on the risk of the lease up, which in turn we get a better price for that. We've JV'd now with a few developers where we're actually coming in on the ground, right, and working with them to build it from the ground up. So I think there was another one that we did that was not quite stabilized. The lease up had started, but it wasn't stabilized. So anywhere in between that, right?
So how do you deal with the financing when it's a new development and hasn't been stabilized yet? Like,
Yeah, that's been the one moving the most, right? Is the debt. I want to say so. Local banks were a good option, especially on the lease ups and the ground up stuff. Their leverage has come way down. So now we're looking at other options. We've looked at some equity funds. Actually, the one that we just closed today.
congratulations.
Yeah, thank you. Is one at CO. So they just have the CO. Actually, I think six units are occupied now. Um, we were originally going to go with a local bank, and we had a great term sheet, and then that was, I mean, we've had this under contract for I don't know, 8 months, 10 months, something like that. So somewhere in between that, they ended up lowering their leverage. So that's when we went and we looked at an equity fund, and they came back with some really good terms, and that's what we ended up going with. So there's actually no senior loan on it. It's just equity, which is a bit interesting, but it works.
Nice. Can you explain that a little bit more to me? Because I don't know enough about that.
So we're partnering with a debt fund, and they've got the way they have their fund structured. They don't really have to pay their investors that much, at least not current. So they've got a lot more flexibility on how they structure that. So it's structured at a pretty low, I believe, 5% current, and then they get some on the back end.
Hmm. Interesting. Okay, that's cool. Um, and debt is just one side of it, right? And so the other side, we talked a little bit about the equity portion, but I also wanted to ask you about the asset management because I know you had a like third party management before, and now I know you have them in house. So for people that don't have in house management, what were you doing to try to find the right third party property management, to be able to um, deal with tenants and all the other stuff?
Yeah, I mean it's tough, right? And that's, I think, one of the things that doesn't get spoken about enough. You really got to get good at asset management and not so much finding the right, you're not going to find a third party property manager that's going to be plug and play, right? You've got to perfect your asset management and make sure that you're checking your KPIs and that you're really managing that property manager. And then, there are companies that are better than others, obviously. I would say, the ones that listen to your feedback and actually take action and are willing to make changes in staff and because really it comes down to your on-site staff for the most part. And then there is some back end things, right? Like the accounting is definitely going to be on the back end and kind of the support for that on-site staff. But so I mean, you could technically hire a horrible third-party property manager, but get lucky and have some good on-site staff and do decent. But if it's the other way around, if you've got a horrible property management company and you don't have a good on-site staff, it's going to be a disaster. So you really got to find a company that's willing to work with you and accepts that you're going to be on top of them. You're going to be pushing them, and that they work with you on
that. Were there like certain questions or things that you would do to try to find the right one that you prior to hiring them?
Pretty typical things before you hire anybody, right? I mean, references is huge. Asking for their reporting ahead of time and taking a look at it. Asking about how they handle their regionals and their on-site staff and who's responsible for what. I think is very important. We've seen some companies that they put everything on the property manager. The property manager is responsible for every little thing, and there's really no support on the corporate level, which is not good, right? It's too much on the property manager. So I'm trying to think of what else you can ask them. I mean, those are the main things for sure.
And so in transitioning from third party property management to now in-house, what are some of the big changes that you've noticed? Or I'm sure there's a lot of pros to it because you have everything is like under the one umbrella, right? But what have you noticed with the differences, I guess?
The biggest thing is the transparency. Just knowing really exactly where each property is and what the real numbers are. From my experience, a lot of the third-party property management companies, they want you speaking directly to the regional, and the regional is trained to pretty much make everything seem great. So, just the overall transparency is great. And then the fact that we can easily implement new things and we can really drive our culture throughout the community, throughout the team, is really the big difference. And we see it in performance.
Right. So having in-house property management, did you have to find like one key person to be able to build out that team, or how did you do that?
Yes, absolutely. I knew I would be spread too thin to kind of run with it. So yes, we found two individuals that we had worked with in the past that were very strong and experienced, and made them partners, and they came on and really ran with it.
Amazing. Okay. And so partnership, I think, is something that multifamily, everyone says it's a team sport, and so if you're on the right team, things work well, finding the right partners, and if not, then, a lot of people want to sell those assets when you're in wrong partnership. So, what have you done to be able to find the right partners, that you work with? Like, is it just, I don't know if there's like a method, to what you've done in the past, but
I don't know if there's a true method, but the first thing is getting to know them, meeting with them, having lunch with them, um, going out and flying to their office, spending the time to really make sure you like them. Really, I mean, that's that you like them and you think that there's somebody that you can work through things with. I think that's huge. And then obviously doing your homework on them and whether you want to run a background, I'm not against that. Definitely references, anybody else they've worked with, track record. Um, Make sure that overall they're same ethics. I think is important too, and that comes with everything. I've learned that with employees as well when you're building out your team and your companies. To me, morals and ethics comes before anything.
And so my main thing is sometimes when you partner, there are overlapping skill sets, right? Because you typically get along with people that are like you, like for the most part, So, um, making sure that maybe some of your partners have different skill sets or are able to, like let's say you're in acquisitions, they're going to be really good at asset management or something like that. I don't know if there's other than getting to know them and kind of like checking their background, things that you've done with current partners or that you would suggest to other people before moving forward and making it like an entity.
I mean, before making it an actual entity, I would say work with them on different deals, as co-GPs versus actually bringing them into one entity and make sure you guys can work together. It's funny what you brought up there as far as getting along with somebody that's more like you, right? And having the same skill sets. I see that all the time, especially with starters and beginners in multifamily. And it's not going to work, right? Like you can't have a bunch of people that are good at raising equity, but nobody's really wants to speak to brokers and find deals or, vice versa. You definitely need to complement each other. You should try to lay those roles out as much as you can on the front end. With a smaller business, it's kind of hard. You're going to have to wear several hats, but there's still, you can still kind of lay that out somewhat in the beginning.
Right. Yeah, at least having like an idea of what the structure could look like once it grows out. So yeah, I mean, I see like, like salespeople, they really like, they like being together and things like that. So it's like, well,
Nobody's going to underwrite the deal. Nobody's going to headlight the deal. And yeah.
or look at the details of like, or is this actually is this operating correctly, right, with the asset management. So that's just, something that I've noticed. But um on the asset management side, is there like a portion of like deal sourcing, raising equity, or asset management that you prefer and you like to stay under?
Say it again. Is there a what?
So I see like multifamily as like three parts, which is like the deal sourcing, right? And like raising equity and then the asset management, right? So like more of the operation side. Is there something that like you prefer over one or the other?
The chicken or the egg thing, right? I mean, if you can't operate deals, then your deals aren't going to be successful. But if you can't find deals, then you're not going to have any deals to operate. Uh,
Right. The chicken or the egg.
yeah, yeah. I think they're all pretty important. Like, I mean, I think being able to operate a deal is more important than anything. You can't count on the market saving you, which a lot of syndicators have,
Right.
and it's not going to happen, for several years now. So I do think that's a very important part of it. I do think you kind of left out. I agree on those three, but somebody could be really good at finding deals and getting out there and at least getting the deals funneled in. But you do need somebody that can analyze it and underwrite it. And
Oh yeah,
sometimes it's not the same. It's not the same
right.
individual sometimes. But it could be. And then obviously without being able to raise the equity, it's kind of tough to actually close on anything. So uh,
They're all necessary.
I'll tell you this, if you're really strong at raising equity, that's probably the quickest and easiest way to get into a deal, right? So if that's your strong point, I think you're good, and you can work on those other two, right? If your strong point is operating, it gets a little more difficult to get into deals because, like I said, not a lot of people talk about it. Not a lot of people overlook it. Um, so that could be tough, and you should try to get good at one of those other two as well, or partner with somebody that is, right. Yeah. So I think
Do you
that's.
do you have so I was going to say that is do you have like advice for people that are starting out in multifamily now in this market, which is different than than previous markets, to provide value to people that are, a little farther ahead, whether they've done just a few deals or they're much farther ahead than they are, to really kind of grow in this industry. I know you mentioned raising equity, but I wanted to ask you about that as well.
Yeah. So I sort of covered this topic yesterday with my coaching students. We have our weekly call, and kind of brought up, what would I be doing right now if I didn't have the portfolio that I have and the deals that we've got, right? What would I be doing in this market? And what I kind of said from there was it kind of reminds me a little bit of right when COVID happened, there wasn't much you could do. I mean, things were a lot more dead than they are right now. But, what I decided to do in that period of time was really structure the business, really work on the systems and the processes and the team. Um, and I think this is a good period for that, for somebody to really work on those relationships. Take out the brokers to lunch and whatnot. I mean, the brokers are bored out of their mind. They've got nothing to do. Like, work on building those relationships. You mentioned getting into other deals. Reach out to other operators that are busy and try to see how you can help them, and bring value. I will say, don't just reach out to somebody and say, how can I help? Because I get that all the time. It's just like, I don't know, you tell me, like, what can you do? You know, the better option would be, hey, I'm really good at analyzing and underwriting deals. Do you have, more deal flow than you can handle, and can I help you do that? That would be a easy way to get your foot in the door. Um, yeah, so that's what I would suggest right now.
Got it.
Because things
Okay.
are going to pick back up, and you want to be ready when they do.
Right. Right. Okay. So just providing value and making those relationships with brokers and other operators, essentially.
Yep.
Okay. Sounds good. And another thing I wanted to ask you has the differences between working with retail investors, family offices, institutions when raising equity, and maybe some of the different questions that they present or concerns that they may have, or maybe their priorities are they're just different, because they're a different type of investor. What you have noticed in the past.
Yeah, I mean, the private equity is going to be a lot about the numbers, right? They do want to, you want them to like you for sure, and they are going to bet you and your team. So you do have to be ready for that. But once that's out of the way, once you've shown them, hey, I got a track record, and they like you as a group, then really everything from there is going to be the numbers, and you really got to be ready to give them good underwriting, provide everything they need, and really show them why it's a good deal, but show them number wise. not so much the story. You know, investors, your retail investors are more on the story, and yes, you've got more sophisticated than others that may go deep into the numbers, but on average, it's more about the location, the story, and the team.
Got it. Okay. And some numbers, like I have heard before that like family offices and really high net worth individuals are maybe more concerned with the IRR and the equity multiple, whereas maybe a retail investor would be more concerned with like the cash on cash return. Like certain things appeal to one more than the other.
Yeah, I mean, most of them have their exits that they want to hit, and they want to make sure that the deal is going to hit that IRR or equity multiple is one that they look at a lot as far as, you know, really most of them just want to hit a certain annual percentage and average annual of, let's say, 12% or 14%, whatever it is. And then they have that, they also want to make sure that they, let's say, get a 1.5 equity multiple. So it's not so much on the IRR, actually, now that I think about it. But I mean, each group is a little different, right?
Yeah. Okay. And so when dealing with investors and communicating with them after something has closed, what has there been a challenge or an issue that you've been presented in the past where, I don't know, there was a fire or there was like a hurricane or something, something happened that communication with investors of how to handle that, typically for operators. I don't know if you have like a story or a challenge like that you could share, that maybe you learned something about that, along the way once you were communicating with investors what actually was happening. Or COVID, right? Is another
Yeah,
one.
I mean, there's so many. I'm trying to think of which one, right? You know, COVID was a big one, right? We've, I think we've always done monthly. I don't think we ever did just quarterly updates. Maybe way in the beginning, but you know, we went from our monthly updates to a weekly update. Sometimes even, you know, more often if some other news came out. So we definitely like to maybe over communicate, you know, but to me, that's, nobody ever wants to be in the dark. You know, I've been there before as a passive investor with another operator, and it's not fun, right? You want to know
Right.
what's going on with your investment, and maybe you're not going to dig in fully into the update and everything that's in there, but at least you know the gist of it and what's going on. So we're strong believers of constantly communicating. You know, I know there was another deal where you mentioned a fire. We had a fire. We're getting ready to do a refi cash out, and we had a fire a couple weeks before the closing of the refinance, or something like that. And you know that we went back to communicating weekly, right? Letting the investors know what's going on, and you know, we got that fire, the restoration done as quick as possible, and closed on the refinance. So yeah, strong believer of communicating. We like to show a lot of the capex while it's going on. You know, we should provide a lot of pictures and videos, and then we also do investor property tours where we invite all the investors once we've maybe not done the full execution of the business plan, but a good portion of it. We like the investors to come and actually see it, what their
We're
money's done.
working.
Yeah, yeah.
Yeah. Look, we're getting things done. Yeah, that's smart. Very smart. Um, and you also have construction in-house, right?
Correct.
So, tell me a little bit about that. Does the construction go to like the different states, or are you guys just operating in one area? And how do you manage all these different, parts of the whole organization?
Yeah, so at this point, we pretty much go anywhere in the US. You know, it kind of grew to that. At first, we were sticking to Texas, but then as we grew and our crews have no issues traveling, and then all our project managers know it's part of the role, and they're good about it as well. So as far as how we handle it is, we've got a really good team of project managers and site supervisors, and then loyal crews that we've had for years, and it just makes it a lot easier. They know what we want done and how we want it done, and we don't experience some of the headaches that you might, especially in some of these. The smaller the city, the worse. Put it that way.
Yeah. And how have you, you mentioned you had, loyal crews that you've worked with for years. So how have you built out your team so that you can have that longevity, right, with your employees?
Keeping them busy, keeping them busy, and treating them well, and paying them on time. Pretty important when it comes to construction. That's pretty much it. I mean, it's pretty easy to keep people happy in construction as long as you're keeping them busy and you're paying them.
Yeah. And overall, I'm just thinking of, your company, right? Because you mentioned, right, culture is something that you're able to embed more now that everything is in house. So, is there particular core culture or core values that you guys like to have throughout the entire organization? I know you mentioned ethics before. So I don't know if there's like certain like lists that you guys are looking for that because you have to have a really strong team in order to carry all these things out. So I'm just curious how you've built that out and make sure that culture is embedded within everyone.
Yeah, I mean, each company, the construction, the management, the real estate arm, we've each got similar but different core values. But overall, we're looking for somebody that's driven, somebody that understands the vision and the goal that we're aiming towards here, that has good work ethics, right? And is going to do what it takes pretty much. Um, and somebody that understands teamwork, right? And is not all about themselves.
Right, right. So with your team, what have you learned from changing from residential to commercial? I know there's key differences, but also similarities. So is there something that you would tell yourself back when you were in residential, prior to starting this whole commercial empire, that maybe you didn't know before, now that you are, knees deep into it?
Um, Skip the residential and go straight to multifamily. No, it's a different, single family is a different beast. Pretty much completely different team than I had before. It's just different. I don't know how to describe it, but they're both somewhat of a grind, but it's more of the residential is kind of like now and more instant gratification versus the commercial, multifamily, whatever you want to call it. It's kind of building that empire, like you mentioned, or building the wealth versus that instant gratification.
Right. Okay. And there are people even in multifamily um, that have, how do I say it? They prefer different sides of commercial. So there's like smaller multifamily, right? That they'll look into and they'll say, well, I'd rather just kind of own this myself and I own it 100%. as opposed to owning, thousands of units, and you're part of a bigger team and things like that. So you have a smaller percentage. What is your take on kind of the pros and cons of each, that you have seen at least?
Yeah, I've been both, right? And I prefer the economy of scales. I prefer being able to build out a large team and be able to manage the business versus working in the business. Not saying you can't do that with small multifamily. It comes a little harder. And it's not for everybody. You do have to build out a team, and some people don't like working with others, and they want to do as much as they can handle, and that's fine. But so I always tell even my students, like, that's the first thing you got to decide: whether do you want to scale and do you want to really build this massive portfolio, or are you happy owning 150 units, just you, or 200. So first you decide that, and then take it from there.
Got it. Okay. Yeah, I'm just curious because everyone has a different priority or different things that they like. I was just curious which one, um, I guess profitability also, like which one makes the most sense as far as time and things like that, but also which one can be more profitable in the long term.
Yeah, I mean, I think in the long term, you're large multifamily. In the short term, possibly the smaller.
Got it. Okay. So kind of back to like residential and the commercial side, right? Where you're getting more instant gratification,
Yeah.
on the residential side. Okay. Um, and so I know that you're also a coach. So with multifamily coach and coaching other students to kind of do the same thing that you're doing yourself. So what are some of the things that you have seen as a mentor of these students that maybe keeps people from being able to really dive deep into multifamily, or what are some of the beliefs or problems at least that you've seen, right? Because I'm sure it's a common thing.
Yes, yes. A lot of limited beliefs, right? A lot of overthinking things, and kind of getting stuck and just not taking the action. Over analyzing is not a good thing. Yes, you want to analyze things, and you want to make educated choices, but you don't want to sit on things for forever. And I see it a lot, and it's a lot of what I work with my students on is when is enough, right? When you check the boxes, that's it. Now you take the action, right? Now you move forward. And I see it in all steps throughout the process. Whether it's picking a logo, starting the website, silly things like that, and then underwriting deals, and people that have underwritten 300 deals and say they can't find a deal, and it's like, maybe you're overdoing it. Maybe you're doing something wrong. So yeah, that would be the
The
biggest
most
thing.
common thing. Yeah.
Yeah.
Have you so some of the people that maybe started out and started with limited beliefs and over analyzing, have you seen that like they do, or they start doing something, or they start basically hanging out with the right people, or I don't know, they start taking different action that helps them to kind of get past that?
Some do and some don't. I mean, that's, it drives me crazy because I like to see every single one of them do it, but some just don't, no matter what you do. So, I kind of lay it out there, and push as much as I can. And I love seeing, when I do see it, it's great, right? And that's why I enjoy coaching. When I don't see it, it drives me crazy, but
Yeah, it's like just do what I say.
yeah, exactly.
um, And I think, are the limited beliefs mainly about finding it's just everything, kind of what you mentioned,
Everything,
right?
what is the broker going to think about me if I say something wrong? What is this investor? There's no way they're going to lend me money. There's no way I can raise this much money. Um, it's all over the board.
Got it. And I mean, when starting out, I know you said your first deal was 37 and then the second to 16, I think. So, does it make sense to start off bigger or, for people that are just starting out or like 100 units plus or smaller than that, kind of to build up their track record? Um, what do you believe would be best, I guess?
I believe 100 plus is a good place to start. I truly do. Something smaller is going to take a lot of your time, and you're not necessarily going to learn the things that you should. So yeah, I would stick to 100 plus, maybe 80 at the minimal. Like you should still be able to have some on-site staff at 80 units, but I see no need to start in the 20, 40 unit range.
Got it. Okay. And when raising equity, so another thing, right? Like first time raising equity for some of these people, are there like certain groups or like I think some have mentioned like Rotary Club or going to the Chamber of Commerce or something to try to build, some of these relationships with investors that aren't in real estate that you've seen could be helpful for someone.
All of the above. Not a lot of people do it, but the ones that do, you've got to be smart about it. Like you can't literally just join one of these groups and right off the bat, you got to build those relationships. But yeah, I mean, anywhere where you have high income, wealthy individuals is a good place to be. So whether it's a uh, Ferrari club or like you mentioned, Rotary or any specific niche, like if you're in the medical field, definitely join and build out a network of others in medical. So yeah, I do think it's a smart move, and I don't see enough people probably doing it.
So what is next? I guess what are you guys looking to do next in the business? Other or just continue to grow it as far as it can? I don't know if there's a certain goal you guys are looking to reach.
Yeah, I mean, the original goal for this year was to acquire over 3,000 units, which would have put us over 10,000 in acquisitions. Not sure we're going to hit that, with the way the market's been, but we're going to continue to look for deals and take down the ones that make sense. And we've got two right now that we're working on, and a couple others that look promising. So there's always deals in any type of market. You just got to adjust and know how to structure them. I was doing real estate full time back in '08, and same thing, right? Needed to adjust and continue buying deals, and everything I bought after the market crashed, I mean, did great. So yeah, I would say words of wisdom is continue at it. I know it's been a rough year to say the least, and there's probably still some more to come, but stick to it. Build out those systems and processes and make those relationships, and just be ready for when the market starts getting better.
Love it. Okay, great. And what is the best place for people to find you if they want to bring you a deal, if they want to help raise equity, if they want to help analyze or help you in any way? What would be the best way for them to reach out to you, or maybe if they wanted to become a student?
Yeah, I mean, the easiest way is to shoot me an email. So it's George or Jorge, Jorge at elevatecig.com. And then also if you visit our website, elevatecig.com, bunch of information on there, and you can also contact us through there.
Perfect. Okay, well, I really appreciate you coming on. we'll send people your way, and hopefully you are able to hit the goal that you have. But thank you so much. I really appreciate you coming on.
Thank you. It was fun.